Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the first quarter of 2020. During the first quarter of this year, a summary of the 2020 National Housing Conference forecast, an evaluation of pre and post COVID 19 pandemic economic forecasts, the monetary policy actions of the Federal Reserve in response to the COVID 19 pandemic, and a forecast of the impact that the COVID 19 pandemic is going to have on the U.S. housing environment were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the first quarter of 2020. During the first quarter of this year, the National Housing Conference Outlook for the 2020 Housing Economy presentation provides a good overview of the housing environment at the beginning of 2020, and it provides an excellent baseline for evaluating the subsequent impact of the COVID-19 pandemic on the U.S. housing market. The following is an overview of the housing factors that economists at Freddie Mac were concerned with prior to the COVID-19 pandemic. Economic growth is slowing due to weaker investment and global growth. A strong job market is leading to solid consumer spending. Lower mortgage loan interest rates led to a rebound in home sales, but a significant supply shortage is limiting a sales rebound. And a lack of housing supply is a major obstacle to a properly functioning housing market. This in turn is causing many downstream ripple effects. With the beginning of year focus on the lack of housing supply, economists at Freddie Mac were initially concerned with the following issues: slower household formations and more young people living at home, renters scrambling for shrinking inventory, entry-level home prices rising much more than other segments, older homes being rated by higher income households, and first-time buyers moving further out due to affordability pressures. By the month of March, the concern over the lack of housing supply was largely forgotten, as the mammoth implications of the COVID-19 pandemic wreaked havoc on the U.S. economy. In January, the Mortgage Bankers Association released a forecast of the U.S. economy. A summary of their forecasts are listed in the table below. By the end of the month, in March, these forecast estimates were dramatically adjusted by other leading economists to reflect the anticipated impact of the COVID-19 virus on the U.S. economy. As illustrated, the 2020 revised economic metrics are significantly lower than the MBA forecasts. Economists at the Federal Reserve Bank of St. Louis are warning that if the current rates of U.S. job losses continues, the country's unemployment rate could reach a staggering 32.1% by the end of the second quarter. Leading economists at Goldman Sachs, J.P. Morgan, Bank of America, Morgan Stanley, UBS, and Deutsche Bank also paint a very bleak outlook for the U.S. economy. Their forecasts spanned a wide parameter of dismal economic forecasts for 2020. However, most of the economists at the big banks still predict that the U.S. economy will rebound later in 2020 or by 2021. Leading financial journalist Robert Samuelson stated that the U.S. economy may be heading into a depression. The impact on the U.S. housing market is expected to have a dramatic impact on the number of home foreclosures, home loan delinquencies, real estate transactions, and home building. The anticipated impact on home building will exacerbate the problem with the existing lack of housing supply. Although the U.S. began the quarter with a very strong economy, according to the March jobs report, by the end of the quarter, 701,000 jobs were lost. The unemployment rate increased from a 50-year low to 4.4%, and jobless claims increased astronomically to 6,648,000. The collapse of the job market was a direct result of the national lockdown to combat the COVID-19 virus. Similar strategies of social isolation were used by countries throughout the world. Only Sweden maintained a status quo business and social environment. In terms of the capital markets, the Dow Jones Industrial Average rose from 28,828 on January 2nd to an all-time high of 29,551 on February 12th, before collapsing to 18,592 by March 23rd. The Dow Jones Industrial Average rebounded slightly to 21,917 by March 31st. Global indices such as the FTSE, DAX, CAC, Hang Seng, and Nikkei performed in a similar fashion. By the end of the quarter, 245,573 coronavirus pandemic cases and at least 6,058 deaths were reported in the U.S., and at least 1,026,974 cases were reported worldwide. Only Italy and Spain had more cases than New York State. By mid-March, a national stay-at-home order was recommended by the White House Coronavirus Task Force. In response to the COVID-19 pandemic, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached a new all-time low of 3.13% on March 2, 2020. The previous all-time low of 3.31% was reached in November of 2012, and the all-time high of 18.63% was reached in October of 1981. For the first quarter of 2020, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 3.76% and ended the quarter at 3.75%. In view of the global COVID-19 pandemic, the Federal Reserve reduced the target range for the federal funds rate from 1.5% and 1.75% to 1% and 1.25% on March 4th, and then again on March 16th to a target range of 0% and 1.25%. The Federal Reserve also announced that it would purchase at least $200 billion in mortgage-backed securities bonds in order to stimulate the economy and ensure that banks have enough capital to anchor the financial system. The impact of the COVID-19 virus on the U.S. housing environment will be dictated by the duration of the global pandemic. Currently, states across the U.S. have implemented policies that have forced the closure of non-essential businesses, stringently encouraged social isolation, and put in place curfews in some highly affected areas. The duration of these state policies have not been specified because many crucial questions about the COVID-19 virus are still unknown. Accordingly, the following questions need to be answered before an accurate assessment of the impact of the COVID-19 virus on the U.S. economy and housing can be determined. First, do survivors of the virus develop antibodies that will make them immune to the virus? Conventional wisdom is that survivors will be immune. However, this has not been proven. Second, will warm or cold weather mitigate the spread of the virus? Warm weather may mitigate the impact of the virus, as it does for the flu, but this effect has not been proven. Third, will the virus reoccur in the future? It is impossible to know the answer to this question. Therefore, a vaccine is required. This in turn may cause a disruption in the U.S. economy that may last for 18 months or more. And fourth, given the contagiousness of the virus, what is the acceptable infection level among society before the economy can resume business? This crucial question has not been determined. Currently, it appears that the apex for the COVID-19 virus will be reached in all 50 states by the end of April. Nevertheless, regional decision makers are going to determine when their portion of the economy can begin to return to its status quo, and at what rate it can return to a state of normalcy. Overall, the expected impact of the COVID-19 virus on the U.S. housing market is an increase in the number of home loan delinquencies, an increase in the number of home foreclosures, a reduction in the number of real estate transactions, and a further curtailment of home building. The most pessimistic outlook for the COVID-19 virus would be a scenario exhibiting a high mortality rate, thus causing a significant amount of unpaid mortgage debt due to the death of many homeowners. However, this problem would likely be mitigated by the pent-up demand for housing. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, The justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Atkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Atkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Atkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Atkins Residential Home Valuation Analyzer. Moving away from the outlook for housing in 2020, the implications of the healthcare crisis, and the monetary policy actions of the Federal Reserve, and instead focusing on an assessment of the price level of homes across the country, it is important to note that for the first quarter of this year, 24 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.75% to 0%. In order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amount. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $125,931 and $272,635. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $291,125 and $485,016. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 36 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, Baltimore, St. Louis, and Indianapolis were classified as the top 5 most underpriced cities in the index. Detroit and Jackson were classified as the most underpriced cities in the index based upon both their higher justified mortgage loan interest rate amounts and their justified percentage of household income amounts. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.75% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. This is Troy Atkins, saying thank you for taking the time to listen to this presentation.